All right, welcome to today's Market Explainer. We're going to be conducting a top-down, strictly institutional analysis of gold, or XAUUSD. We're stripping away the retail noise, the lagging indicators, and focusing purely on smart money concepts, institutional order flow, and precision liquidity mapping. Let's dive in and see exactly how smart money is positioning.
Right now, gold is approaching a massive liquidity zone. And frankly, smart money is likely already positioning ahead of the next major expansion move. Understanding these underlying mechanics is exactly what separates professional, institutional execution from retail guesswork. Now, before we break down the charts, if you want to follow future trading opportunities and to execute these exact setups, you can open a trading account with our friendly broker, FXTM, using the link penned right down in the comments below.
Okay, part one, let's look at the macro context and fundamentals. Look, institutional order flow doesn't just exist in a vacuum, right? It's fundamentally driven by macroeconomic catalysts. When we look at the upcoming economic calendar, the primary drivers for the US dollar this week are crystal clear. We've got the US Consumer Price Index, the CPI, followed right up by the Producer Price Index, the PPI. These are incredibly high-impact inflation metrics. You have to remember, smart money actually relies on the volatility generated by these specific data drops to forcefully push price into technical points of interest, like unmitigated order blocks or fair value gaps. So absolutely expect some market manipulation around these release windows. Beyond the hard data, we are also dealing with some rapidly shifting geopolitical and monetary policy sands. Just recently, we saw an agreement to halt mutual attacks between Israel and Iran, which was facilitated by US intervention. Now, this temporary de-escalation initially weakened the US dollar and gave some temporary support to commodities. But, and this is crucial, Israeli Prime Minister Netanyahu has explicitly warned that the broader conflict is not over, and Iran has issued severe warnings of their own against further strikes. So geopolitical risk remains highly elevated. Concurrently, US inflation concerns haven't vanished. The markets are currently pricing in a 42% probability of a 25 basis point rate hike by the Federal Reserve this December. Higher interest rates typically prop up US Treasury yields, and that in turn aggressively caps the upside for non-yielding assets like gold. So this fundamental backdrop strongly suggests that the path of least resistance for gold is actually to the downside.
Moving on to part two, higher time frame market bias. With that fundamental narrative locked in, let's shift to the charts. Looking at the 4-hour time frame reveals the sheer aggression of recent bearish displacement. I mean, look at this. We have a crystal clear bearish market structure. Notice those large, expansive red candles breaking previous lows? Those are definitive market structure breaks to the downside. This represents serious institutional selling pressure. Price has broken lower from an upper premium array, and it's swept liquidity right below those recent equal lows. So the daily and H4 bias are heavily aligned to the downside. But while the higher time frame trend is overwhelmingly bearish, we absolutely must evaluate where price currently sits within the delivery cycle. If we take the entire H4 dealing range from the high up near 45.14 down to our external liquidity target near 42.80, the current price hovering around 43.30 is actually sitting in a deeply discounted area. It's resting right above a lower mitigation block. Selling blindly down here in a deep discount, that's retail behavior. Institutions are going to wait for price to rally back up into a premium before initiating any short positions.
Let's get into part three, liquidity and order flow analysis. To figure out exactly where price is likely to retrace before it continues its descent, we need to zoom into the lower timeframes. Looking here at the 1-hour chart, our attention gets immediately drawn to those large, red shaded regions sitting above current price action. During that aggressive H4 drop we just looked at, the algorithm left behind a massive, unfilled bearish fair value gap between 43.60 and 44.10. The market is incredibly inefficient right there. And this void, it acts like a powerful magnetic draw on price. Institutions are highly likely to engineer a short-term rally just to rebalance this inefficiency and mitigate that bearish order block sitting up in the premium zone before they continue driving price lower. Dropping down further to the 15-minute chart, we can actually see this internal retracement starting to form. Notice the internal buy-side liquidity resting directly above those relative equal highs, near the 43.40 to 43.45 area. And then below us, we have clean sell-side liquidity clustered at the 42.80 to 42.90 zone. Right now, price is building a localized bullish displacement, essentially an internal change of character, designed to sweep that immediate buy-side liquidity and tap right into that H1 fair value gap. Which brings us to part 4, institutional trade setups. Based on this entire confluence of macro data, higher timeframe structure, and lower timeframe liquidity mapping, we can construct actionable, highly objective trading plans. So here is our primary, highest probability setup.
the bearish continuation. We want to sell short into the institutional rally. Our entry zone sits between 43.35 and 43.45, which aligns perfectly with the mitigation of the recent bearish displacement and the lower edge of that H1 fair value gap. Now, we do not use blind limit orders. Our confirmation trigger is a 15-minute or 1-hour change of character to the downside, strictly after price sweeps those minor equal highs. The stop loss goes above the entry zone high, so between 43.55 and 43.65. We'll take initial profits at 43.10 and then leave a runner for that major draw on liquidity down at 42.50. That gives us a beautifully favorable risk-to-reward ratio of 1 to 4 or greater.
But the market is dynamic, right? So we also have to plan for the immediate term. Scenario 2 is a tactical, counter-trend long position designed purely to capture the rebalancing phase as we move up into our premium sell zone. For this, the entry rests in the 15-minute bullish order block between 43.22 and 43.28. The trigger here is a lower timeframe market structure shift with clear displacement the moment we tap this zone. Stop loss is kept tight at 43.05. We're going to scale out at the first buy-side liquidity pool at 43.45 and then keep a final target deep inside that H4 bearish breaker at 44.15.
Part 5. Trade Execution Scenarios.
Having a plan is really only 20% of the equation here. Professional institutional trading is defined by strict execution parameters and ruthless risk management. Objectivity is everything. Our primary bearish continuation scenario holds about a 70% probability. Why? Because it aligns flawlessly with the higher time frame bias, the fundamental macro pressures on the dollar, and the reality that price is currently seeking deep discount liquidity. However, this entire thesis is invalidated if we see a sustained break and a daily close above 43.75. That tactical bullish retracement, that holds roughly a 30% probability. It's counter-trend and it relies heavily on immediate lower time frame market structure holding up. A body close below 42.95 completely invalidates this bullish thesis. If those invalidation levels get hit, we don't sit around hoping or praying. We accept the loss, we step back, and we wait for better confirmation from smart money.
When it comes down to execution, discipline is entirely non-negotiable. Step 1. You execute these setups strictly during the London or New York session overlaps. That is where the true institutional volume and displacement actually happens. If price hits an entry zone during the low-volume Asian session, sit on your hands. Do not enter. Wait for the London open manipulation. Step 2. Protect the capital. Your maximum risk allocation per trade must absolutely not exceed 0.5% to 1.0% of your total account equity. And Step 3. Pay yourself. Once take profit 1 is hit and that immediate liquidity is swept, close 50% of your position and trail your stop loss to break even. That guarantees a risk-free run for the rest of the trade as we target those higher time frame levels.
And that wraps up our institutional breakdown of gold for this week. By aligning yourself with the macro narrative, identifying that unmitigated order flow, and executing with incredibly strict risk parameters, you place yourself firmly on the side of smart money. So the real question to ask yourself is, are you trading the reaction or are you actually positioning for the displacement? If you found value in this explainer and you want more professional, institutional-style market analysis using smart money concepts, make sure you're subscribed. And again, to follow future trading opportunities and execute these exact setups, you can open a trading account with FXTM using the link pinned in the comments below. Stay disciplined out there and trade the smart money flow.